Welcome to the Retirement Made Easy podcast. I'm your host, Greg Gonzalez. My goal for the podcast is to help you live a better life in retirement by giving you the tools and information you need in a language that you can understand. On today's episode, we're going to be discussing who's the better investor, men or women. We're going to talk about multiple studies that all come to the same conclusion. We're going to be talking about the difference between men and women and what makes one gender the better investor. One study in particular that we'll talk about was done by Fidelity, where they actually named the characteristics that resulted in the higher performance of this gender. Before we get started with today's show, I wanted to remind listeners they can check out our website, which is retirementmadeeasypodcast.com. That's retirementmadeeasypodcast.com. While you're there, be sure and download my Retirement Secret Sauce, as well as the 2020 Tax Guide. Both can be found for free at our website. And while you're there, you can even listen to past episodes, or you could submit your question for the podcast. We always love hearing questions from listeners, and with your permission, we'll discuss your question on a future episode. Let's get right into today's episode. We're going to be setting the record straight. Who's the better investor, women or men? In short, we consistently find that women are better investors than men are. We're going to discuss 3 different studies that all came to the same conclusion that women have higher annual rates of return than men do on a consistent basis year in and year out. And then we're going to talk about why that is. What makes women better investors than men? The studies actually broke down the characteristics of how women were investing that made them the better investors and resulted in higher performance every year. Hopefully all the men out there listening to this podcast can learn from these studies and learn what women did and why they're better investors. Then the men can change their behavior and just mimic what the women are doing. The first study was done by researchers at Cal Berkeley. The study was titled Boys Will Be Boys: Gender, Overconfidence, and Common Stock Investment. The study was done of 35,000 households of men and women, and the study took place between 1991 and 1997. So it wasn't just a one-year fluke that the women had better performance. And it wasn't just a fluke that it occurred in a couple different households. This is 35,000 different households that the same truth applied. What researchers found at Cal Berkeley in this study was that women outperformed men by almost 1% per year between 1991 and 1997. Another thing that the researchers found interesting was that men changed investments 45% more than women did during that period between 1991 and 1997. It's kind of like men driving a car. They're always switching lanes. They want to get in the fast lane. Then that lane slows down. They move over to the center lane. Whereas women, they kind of stick in their lane and they're more patient. I tell my clients all the time, the more you handle your long-term investments, the less they seem to grow. It's kind of like a bar of soap. The more you handle that bar of soap, the smaller it gets. The next study I want to talk about was done by the Warwick Business School. It was conducted in 2012 through 2016, so 4 years. This survey wasn't as big as the one done by Cal Berkeley, but it comprised 2,500 different investors, and it found that on average, during that time period, women outperformed men with their investments by 1.2% per year. So almost identical to the study done by Cal Berkeley. However, the study was done almost 20 years later, and they still got the same results as the study done by Cal Berkeley. So it wasn't a fluke with the time period. We're seeing a pattern here. Women are consistently, with both studies, outperforming men by 1% per year. And the last survey results I wanted to discuss today is from Fidelity. If you're not familiar with Fidelity, they are a huge brokerage firm. In fact, they're one of the largest 401k providers in the entire country. And in 2017, they had around $6 trillion in assets under administration. This particular study that Fidelity conducted in 2016 spanned over 8 million investment accounts, comparing the success that women had in their returns versus the success in returns that men had. Fidelity took it one step further and analyzed the behavior of men versus women and why the women and their behavior allowed them to reap higher returns. If you think about it, in this study of 8 million investment accounts, the amount of data that Fidelity is working with is absolutely astonishing. What was really interesting about this study was Fidelity broke out its retirement plans like 401ks from its individually held retail accounts, such as maybe a Roth IRA or a trust account, but the results they found were nearly identical. At the beginning of the study, they asked the women if they thought their investments would outperform the men's investments. Shockingly, they found out that only 9% of women felt that their investments would outperform men's investments. And they found men were much, much more confident, even overconfident, you might say. Another interesting finding from the study was that women save more on average than men do. When Fidelity looked at workplace savings like 401ks, women saved an average of 9% of their paychecks, compared to an average of 8.6% saved by their male counterparts. Then Fidelity looked at accounts outside of workplace savings, such as maybe an IRA or a brokerage account. In those accounts, women added an average of 12.4% of their account balance. Meanwhile, men only saved an average of 11.6% of their account balance. During the study period, the women averaged a 6.4% annual return, whereas the men only averaged a 6% return. So it's only a 0.4 or roughly a 0.5% per year difference. But Fidelity pointed out that that can be a huge difference when it comes to a lifetime of investing. Not only are the women saving more each year for retirement, but they're earning more in their accounts due to their style of investing and their behavior. And that's what Fidelity looked at next, was what specifically were women doing differently than the men? What they found was women, on average, were long-term investors, and men were more short-term focused investors. They also found that women were more diversified than men. Men seemed to take more risk in concentrated positions. Fidelity had a team of behavioral psychologists, and they found that men were more likely to be overconfident in their ability to actively manage a portfolio, and this led to overtrading and higher transaction costs. Another factor they found relates to how each gender responds to, let's say, momentum swings in the market, either up or down, and every investor is going to react differently to losses or to gains. But an overconfident investor, which they found in men, often feels an extra urge to buy more when things are looking good to capture more gains, or to sell more in tough times to prevent future losses. Fidelity's researchers found that men were more vulnerable to such impulsive behavior on average. Reading these results was absolutely music to my ears. In my experience as a financial planner, every successful investor I've ever known was acting continuously on a long-term plan. And every failed investor I've ever encountered got that way by reacting to current events in the economy or scares in the market. At some point, they lost their long-term focus and they let their emotions get the better of them. This study from Fidelity found that that was one of the big contributing factors to the lower performance for the men. Meanwhile, the women not only saved more, they were more diversified, and they kept their long-term focus and didn't make emotional decisions based on a current event or a scary news headline. Fidelity also interviewed the men and the women, and they found that women, on average, were a lot more willing to ask for help than the men were. This is exactly like when I was a little kid and I was driving in the car with my parents. My mom would be telling my dad, pull over, ask for directions. And my dad would be behind the steering wheel saying, I got this, I'm just taking the scenic route. My dad would never ask for directions. My mom would be so ticked off, but that's the difference between men and women. Was my dad overconfident in his ability to get us there, just like the average male investor? Probably. But I can tell you one thing, we never pulled over to a gas station to ask for directions, or at least not with my old man driving. Similar to the Cal Berkeley study, Fidelity researchers found that men were 35% more likely to make changes to their portfolio than women were. Fidelity determined that this was because women were more inclined to stick to a long-term plan, especially during market fluctuations. Over the years, I have found this to be true time and time again. Women, they love a plan. When we draw up a retirement plan, women absolutely love it. They want to take it home. They love that we bind it for them, and they want to stick with the plan. I don't know what it is, but women prefer having a written retirement plan. In my experience, women seem to appreciate something in writing that shows them a plan to get them from where they are now to where they want to be in the future. Fidelity's survey showed that 90% of women were looking for more financial education, so they had more confidence when it came to retirement planning. In my opinion, investing successfully takes a discipline to save, patience to let time work for you, and a commitment to stick with your plan. These 3 studies prove that women are better at these 3 elements of investing than men are. What can we learn from these 3 studies collectively? We learn that women are better investors than men. On average, they get about 1% higher annual returns than men do. We also learn that this better performance that women experience is due to their behavior. Women don't let their emotions and short-term interruptions in the market threaten their long-term investments. 2 of the 3 studies proved that men were between 35 and 45% more likely to sell their long-term investments whenever the market got shaky, whereas women, they hung on to their long-term investments. Also, we learned that women's investment portfolios, on average, were much more diversified than men's portfolios. This might be a factor in their higher performance every year. We also learned that women were more likely to ask for help when it came to investing. This is another contributing factor to their higher returns. I've actually thought about making some t-shirts that say, invest like a girl. If we learn anything from these 3 studies, you'll get higher returns if you do. That's it for today's episode of the Retirement Made Easy podcast. As a final reminder, check out our website, which is retirementmadeeasypodcast.com. That's retirementmadeeasypodcast.com. You can download some free resources there, such as my retirement secret sauce, as well as our 2020 tax planning guide. Thanks for listening today, and remember, always dream big. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, please consult your attorney, financial advisor, or tax advisor prior to investing. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Securities and advisory services offered through LPL Financial, a registered investment advisor, member of FINRA, SIPC.